All right, in this video, I'm going to talk a little bit about the differences between debit cards and credit cards. So let's start off with credit cards. Credit cards constitute a loan. So when you use a credit card to purchase something, then the credit card company is lending you money to make your purchase, and then you pay it back at some point later. Hopefully, basically within the payment period after the bill arrives, hopefully completely in full. So basically, it is a loan, and interest can be very high on those loans. So it's not uncommon to see credit cards that are carrying interest in the mid to high teens in terms of like 15%, 17%, things like that per year. And if you trigger any of various characteristics like some late payments, it can trigger penalty APR rates that can be in some cases close, almost 30%. It can be very, very high and very nasty. So from that standpoint, the interest rate can be high. Now, significantly, if with a credit card, if you pay your statement in full every month, then you can avoid paying interest entirely. Because basically what happens is there's a window of time during which you make your purchases, and it's basically the kind of the billing period. And so you make your purchases, and then after you get that, at the end of that period, basically the credit card company takes all those purchases and they send you a bill, whether electronically or paper or what have you. They send you a bill and it specifies what all of the purchases were and what your total balance is and also what your minimum payment is. Now, if you and when you need to pay by, and if you pay in full before the due date for everything that was on that statement, then you can basically avoid paying interest. And so as long as you pay in full every time you get your statement and by the time the due date, then you can avoid paying interest, which is really significant. So you don't have to pay the interest if you're paying in full at the end of every period, but you are still building credit because you are using that and you're demonstrating history of on-time payment and things like that. So, some people have the odd idea that you have to have, carry a credit card balance from month to month and not pay it off in order to build credit. That's not true. If you have a credit card, you use it, you pay it in full when the bill comes, you're going to build credit. And if you're paying it in full every time the bill comes, as long as you get that payment in before the due date, you can avoid paying interest on it too. So that's good if you're paying in full. So for a credit card, because it is a loan, the amount you can spend is limited to whatever the card limit is. And generally, the credit card company, when they issue the card, will ask some questions about household income and things like that before they, and also going to look at your credit history before they start issuing a card limit. And so if your income increases over the years, then sometimes they will increase the card limit. Now, it's important to note that for a credit card, the consumer has a limited liability for fraudulent activities. And what I mean by that is if somebody steals your credit card and engages in fraud, there's a limit to how much liability you, the credit card owner, have. So the maximum liability for unauthorized use is $50. So if somebody steals your credit card and they start using it in an unauthorized manner, assuming you're reporting it and everything else, and you say, hey, wait a minute, this is not the right charge. Basically, your maximum you're on the hook for is $50. Now, interestingly, if the fraud is solely due to a stolen number, so maybe a thief doesn't actually get your card, but they manage to somehow steal your number, then in that case, the fraud due to the stolen number is limited to zero. So basically, you're not held liable for that. So now, the one little exception is, I suppose if you never realized that somebody was using your card and you just went along paying and paying, I suppose you could wind up paying for a bunch of stuff. But if you find that there are unauthorized transactions and you report them, say, hey, these are unauthorized, basically the maximum you're on the hook for is $50. And that's basically if it was an unauthorized use of the card or somebody stole your actual physical card. If they just stole the number, then you're limited to zero. So there's some pretty good fraud protections with credit cards, and as a result, credit card companies tend to be, fairly decent, or at least they have an incentive to be decent at trying to determine if there's fraudulent activity. And so if you're going on a very out of character kind of trip, it might not be a bad idea to contact your credit card company and just say, hey, I'm going out of town. If you see a whole bunch of charges from the other side of the country all of a sudden. That's probably me. Don't just immediately cut it off. So it might not be a bad idea. It's a very out of character kind of a trip, something like that. Now, let's talk debit cards. So debit cards are linked to a bank account. And so basically, when you use a debit card, what's happening is it's essentially the more modern equivalent of the old paper checks, where basically you'd write a check, and basically what that meant was money was going to come out of your bank account. It took a little while to occur historically, but that was the idea. Well, the debit card, basically, you're doing the same kind of thing. Money's to be pulled out of your account. So it's linked specifically to an account. Now, as a result of the fact it's linked to your bank account, there's no interest. So you're not charged interest on that because you're just spending your own money. Now, I should note there is a way in which you could conceivably wind up paying interest, but that is if there is overdraft protection, right? In which case, basically, the bank lends you money if you overdraft your account. So if you spend more money than you have, and then you have overdraft protection, which meant that the bank lends you the difference, well, then you could wind up with possibly paying some interest and fees and all kinds of things. But as a little side note, what that would mean is that's kind of a failure of budgeting if you're spending money that's not actually in the account, right? You shouldn't be trying to buy something that costs more than the money you have in the account when you're using a debit card, right? So, and that leads us to kind of the next point, and that is that because of that, your spending is limited to the account balance. So pretty much whatever money you've got in the bank, that's what you've got available to spend. Whereas with credit cards, you're borrowing money. So one of the downsides of credit cards is because you're borrowing money, it's possible that if you spend recklessly and you buy a whole bunch of things, you rack up a couple $1,000s of a credit card balance, the bill is going to come due and you may not have the money to pay it, and then you are going to wind up paying interest on that. And so that's potentially bad. Now with the debit card, possibly with the exception of certain overdrafts protection scenarios, aside from that, basically you can't spend more money than you've got. So that's worth noting. Now, an interesting aspect of debit cards that I would characterize as sort of a downside of debit cards is that the consumer liability can be very high potentially, and it depends an awful lot on the speed of reporting. So it depends an awful lot on how fast you report that there is some kind of fraud going on. So if let's say your debit card is lost or stolen, and if you report it within 2 business days of realizing that your card was lost or stolen, then you're limited to $50 of liability. So they can only get away with taking $50 out of your account. If you've reported it within 2 days, 2 business days of realizing that loss or theft. So what that means is if somebody steals your wallet or purse, or you can't find your wallet or purse, and it's got your debit card in it, you should basically report it as potentially stolen pretty much immediately. Now, if you are past the 2-day period, but you are reporting it within 60 calendar days after the statement is sent to you showing the fraudulent activity, then the limit is $500. So basically, if the bank sends you a bank statement, and on that bank statement, it shows withdrawals and spending linked to the debit card, and those withdrawals and spending are fraudulent, then if you report that within 60 days of receiving that statement, then you're limited to $500 loss. And so obviously that's a lot more painful than the $50 loss, but it's limited to $500. So you could lose a maximum of $500 in that case. Now, if you don't report it within the 60 days, and so the statement comes, you don't look at it, and there are fraudulent charges on there, and you don't pay any attention to it at all, and 61 days elapses, and then you're looking at the statement and you realize, wow, they just spent $10,000 from a bunch of savings that you had set aside for a down payment on a house or something like that, and they spent it. Well, if it is 61 calendar days after the statement that shows all that $10,000 of fraudulent spending, well, you're just out of luck. $10,000 is gone, and you're just out of luck. So now there are some states that cap that at $50, so more like the credit card treatment. But as a default, assume that basically once you have gone past that 60 days, whatever the thief is stolen, it has been stolen at that point. If it's 60 days past the statement. So what that translates to is with the debit card, you better pay real good attention to the statements you're getting. And make sure there's no kind of unauthorized activity there. Make sure you're paying really close attention to what charges are showing up on there. And if there's any reason to believe that your number has been compromised or your card has been stolen in some way, basically report it as fast as humanly possible, because the speed of reporting for a debit card has a lot to do with what kind of liability you have. And so from that standpoint, credit cards are actually considerably more friendly, provided you're budgeting and planning and you're only spending money that you already have to pay off the balance when it comes in. Because basically, even if it's lost or stolen, the maximum liability you're facing is $50. With a debit card, if you don't pay attention, you kind of fall asleep at the wheel. Life gets busy. You have a young child and you're not getting a lot of sleep, or whatever. Life happens. So if something occurs and you don't catch the fact that there was fraudulent activity, if enough time elapses, you're just out of luck. And so that's obviously a lot more risky in that sense. So from that standpoint, the liability can be much, much higher for a debit card. And there's kind of more risk there potentially. Now, as an interesting little note for credit cards, so the Card Act of 2009 basically specified that if you make extra payments, then the extra payments have to go towards the highest interest part of the card's balance. Okay. And so if, for instance, you have a credit card with balances and there are different rates applying to different parts of the balance, some of it is subject to a penalty APR rate, some of it is not. And so basically you've got multiple different rates applying to different parts of the balance and things like that. Then basically due to the Card Act of 2009, what that means is if you send extra money above, and beyond sort of like a minimum payment, things like that, then basically the extra payments have to go towards the highest interest part of the balance, basically because that would result in you paying the least amount of money total in the long run. At least, of course, if you pay it off in full, that's even better. But anyway, so also things like rates cannot be increased on existing balances. And so once you have a particular rate on a specific balance, then basically that rate can't be increased. But rates on subsequent purchases could definitely be increased. And again, that circles back around to the Card Act of 2009 about why they would actually apply the extra payments to the thing with the highest rate. So also, there is a little bit of a difference between credit cards and charge cards. Charge cards are actually cards in which the full balance is required in 30 days. So the full balance is required in 30 days. And basically, the example of this would be some Amex cards. Now, Amex has some charge cards and they also have some credit cards. So if they have a credit card, it follows the same kind of principles we've talked about so far. You don't have to pay the full balance when it's due. You absolutely should, but you don't technically have to. You just are obligated to pay the minimum payment, but then they're just going to charge you interest on whatever you haven't paid. That's the standard credit card approach. The charge card approach is basically the bill comes in and you pay the full amount in that 30-day period there, basically. So you got to pay the full amount in 30 days. So in that case, kind of what happens is because you're not borrowing in the same way, the transactions are approved as they occur. And this is basically going to make more sense for business transactions, where this is just a means for a business to conduct the transaction, which they will then just pay off periodically. So that's a little bit of a difference between charge cards and credit cards. And Amex is basically the main entity that has some charge cards, but they also do have credit cards as well. So it kind of pays to make sure you know what kind of card you're looking at in that context. Okay, hopefully this little discussion of debit cards versus credit cards has been helpful. Be careful and make sure you pay your balances in full, your credit card balances in full. Don't rack up any interest if at all possible, and build some good credit. Have a wonderful day. Thanks for watching.